Fund Supermart, your online gateway to unit trusts.
Hi Nicholas. Within China, Hong Kong, which are some of the sectors you prefer the most? What are the current opportunities in the market?
As you know, at Aberdeen, we adopt a bottom-up stock selection process. We do not focus on any particular sectors. However, having said that, we are able to find some interesting names in certain sectors, for example, consumer discretionary, consumer staples, as well as other areas that ties in quite nicely with the rising middle income and urbanization. For example, we have companies in the travel industry, companies in hypermarket, supermarket, might be going through some rough patch right now because of the anti-corruption drive, but longer term, I think domestic consumption will still be a very important engine. We are not top-down as well, but looking at the longer-term trend, the middle-income urbanizations are the two big trends that are not unlikely to reverse in the new normal of a lower growth rate. So we are trying to find companies that are able to be a beneficiary of that particular trend, or those two particular trends.
People's Bank of China had recently made a cut on benchmark interest rate for financial institutions since 1st of March. What are some of the opportunities and obstacles that will likely surface due to the cut?
The People's Bank of China has been cutting interest rate or adopting a more relaxed monetary policy in the last few months. They are probably seeing quite a bit of a deflationary pressure in the system, and that's why they are embarking on all this monetary easing. As to whether that will directly help to prop up the economy is probably another question, because banks are not really lending. Banks are concerned about lending to some of the companies that need the capital the most, and these are mainly the SMEs, smaller companies, the privately run companies. So as a result, the overall economy may not have the same impact of like in other countries, whereby a cut will definitely be able to help to boost the economy. The impact is not so direct and might be more gradual than in other countries. But having said that, I think the more important trend is to look at the long-term drivers of the economy. Domestic consumption will be important, and those are the two things that I mentioned earlier on that should be focused on: urbanization as well as rising middle income. Those are the two more important factors that investors should look at in terms of opportunities, because those sectors are still doing pretty okay right now.
How will the stronger US dollar affect Chinese equities?
There isn't a direct impact in our view. Yes, the cost of funding of companies in China or even in Hong Kong who rely on a cheaper cost of funding in the US dollar in the past may have to rethink about their funding source right now. And companies that have some sort of mismatch of revenue that might be in yuan or in Chinese renminbi, they might have borrowed in US dollar. That sort of a carry trade or arbitrage may have to be unwound, or may have to rethink about that strategy now. But back at Aberdeen, we do like companies to speculate or to have sort of a carry trade, if you like, in the way of operating the business. We prefer companies that are much more simple and just borrow in the local market, and there's no mismatch of currency between the revenue and the liabilities. So those are the type of companies that we focus on. But back to the market itself, with a rising US dollar or rising rates in the US, that might have a more profound impact on the way that the market is speculating, or the way that the market is behaving at this point, or for the last few years. Because cost of money has been too low for many years. That has resulted in a lot of speculation or indiscriminate buying of stocks, regardless of quality. But with a rising interest rate in the future, emerging market will see a higher cost of funding, and as a result, only the stronger players or stronger companies will survive better than the lesser run companies. In this kind of environment, the market will be much more discriminate in terms of what they buy, and that will be beneficial to to the Aberdeen style in certain ways because we focus on quality companies that have strong balance sheet.
What are your views on Chinese equities given its relatively cheap valuations?
Yes, as I mentioned earlier on, the valuation in the average or weighted mean sense is still quite low. But a strong word of caution is that not every stock is cheap. The cost of funding being very low for the last few years has meant that speculative funds or flows have been going into the internet companies of the world and some of the healthcare thematic stocks or new environment or environmental stocks have gone up quite a lot. But we feel that some of these stocks are not of a high quality, and valuations is not that cheap. So you have to be very discriminate and very careful with valuations. Not every stock is cheap. Even though on a mean basis, on the surface it looks cheap, one has to be very careful. And the good thing about Hong Kong market, something that maybe the market is ignoring, Hong Kong domestic companies, these are the companies domiciled in Hong Kong but with exposure to mainland China, they are still trading at a pretty attractive valuations. So maybe that is one way of playing China, not a direct way but an indirect way, and it doesn't come in a very expensive way because valuation of the Hong Kong domestic stock is still reasonable. And then you also have the H share class of some of the dual listed companies, and that is also cheaper than some of the A share companies after the recent rally. So there are ways of finding cheaper companies by looking at different share classes or finding different way of getting exposure to mainland China. So this has always been our approach to investing in China.